We are going to get started on the presentation today. And today we're going to do that mid-year update on sales tax that we like to do. So our experts, Tom and Gerad, are going to be going through all the recent changes. There's a lot of state changes that they'll hit upon, some feature ones they want to talk about, tax collection, tax rate changes, and again, the economic nexus is going to be a big part of today's update. I am Carolyn Powell. I am your host today, and we'll be getting us started with everything. As I mentioned, there is a toolbar box to the right to grab a copy of the handouts for today, being the presentation and also the bios of our experts. I'll go through everything. There's a couple things after the presentation. You will receive a copy of the slides later this afternoon, a link to the recorded session, and then also you'll immediately get a survey asking you for feedback if you have questions on any topics. If you want to meet with any of our experts one-on-one or talk with them, you'll get an immediate survey for that. So let us know how we can be helpful through the survey, or again, the email I will send you this afternoon. Without any further ado, I'm going to introduce the experts, but I think you guys know them quite well already. We have Tom with us today. He is a CPA and partner here at the firm. And he has over 20 years experience. State and local tax is his thing, so he will be going through things with you with Gerad, with again over 20 years experience. Gerad has a little bit varied background. He's been in public accounting, but also private industry with New York State Department of Tax and Finance for over 6 years. So he brings a little bit different perspective for you to the conversation and questions and just angle he looks at. We are going to start just quickly this morning with a couple poll questions, just so our presenters can kind of angle some of their conversations and help you in the best way. So I'm going to get started with the polls. And the first one, how often do you review your sales by state? All right, Gerad, where do you think this is going to come in?
I'm going to say probably yearly or not at all.
Okay. Hopefully that's not it.
Let's hope it's yearly.
Yeah, okay.
At least.
Is that going to be the correct answer?
It's an okay answer. Best answer. Certainly, we won't give it away until
Everybody's in. Okay. We got 76% voted, so we'll give them just another minute or two. If everybody wants to vote, we'll close this out so we can keep it moving. All right, I'm going to close it out with where we are. Hang on. And I'm just going to share the results. So it looks like most people monthly, yearly, and some aren't sure if they're supposed to be doing this. So I think they're at least in the right spot listening to today's webinar. Next question. Hang on, let me get over here too. How often do you review the states and the threshold updates? I'll launch that if everyone wants to just answer. Same options for you. Tom, where are you thinking this one's going to come in?
Yearly, or am I supposed to do this?
Okay. We do have a couple confused people out there, but
They have been changing pretty frequently, as we'll discuss.
okay. All right, I'm going to close this out. Last minute votes, get them in. Okay. Share the results. Okay, we have a lot of yearly people, some unsure, some monthly, and some aren't sure they're supposed to be doing this. So, and then I'm just going to go quickly to the last one. What resources are you using to keep up with all these changes? What do we think, guys? What are we hoping they're using? What do we think they're using? I guess is the first.
Although Google's gotten to be,
The AI part of it's pretty interesting.
yeah,
It's getting better. I wouldn't say it's 100% reliable.
it at least gives you a starting point.
Yeah,
Yeah.
place to start.
Okay, looks like most votes are in, and I'll close this one out. And it looks like a lot of people are using the research tools and Google. Some of them using our webinars, perfect place to get these updates, advisors. And again, some are not sure they're supposed to be doing this. So I'm going to have the guys turn their cameras on. We'll get started. You can stop looking at me, look at them, and get them started today on all this good information. Thank you.
So good afternoon, everybody. Thanks for joining us again for another webinar on some sales and use tax updates and developments. We're calling it our mid-year. I mean, I know it's already start of fall, but there's been a lot of new guidance and developments from legislation that was passed in the last couple of months. So we thought it was a good time to really share some of this and discuss it, since a lot of these changes are effective starting in October, as you'll see. So we're going to talk about some recent trends to kind of get things started. Jared's going to start off with that just to get everybody in the right frame of mind to talk about sales tax. And then Gerad and I are going to go through a number of state updates. We have a good number of states on here this time around to talk about. As I said, it was a very busy summer legislatively, and there were a lot of states passing new laws or expanding their sales tax base, which we're going to get into. And then to close things out, we'll talk about what we're looking at in 2026, what we can expect some states to be moving towards in the future now. So I think, Gerad, you're going to kick it off and talk about some recent trends.
Yeah, sounds good. Thanks, Tom. So this first slide we wanted to point out that sales tax has actually climbed up the charts to be the second largest source of tax revenue. And like Tom mentioned earlier, is, you know, states are expanding their tax base, and you can see this is the direct result of it. So now sales tax has surpassed income taxes, where in the past, you know, folks have been heavily focused on income taxes and then sales tax as well. I'll get to it when I can. But obviously now you can see the pain points that may come about, you know, if sales tax isn't prioritized. So, I mean, states are focusing on it, they're expanding the base. So there's certainly some things we got to keep in mind. So, so let's take a look at the next slide, and we'll talk a little bit about, you know, sales tax rates. Most cases are certainly higher than income tax rates. The way taxes are applied are different, you know, so those are things to keep in mind. If you look at the chart, just to point out a couple things, you can look at Louisiana, even though they're a southern state, and that's kind of the misnomer, is that, oh, I go south, my taxes will be lower. But when you start to add all the taxes together, you know, you have the states in the south that actually have higher sales tax rates that are making up for maybe no income tax. Or a lower income tax rate that they might impose. So these are things to look out for. So you'll see even Louisiana's, the Alabamas, they're actually as a rate are higher than, you know, the states that are thought of being the highest, which is generally New York, Washington, and California. Yeah. So, so that's something to share there. The next thing we wanted to talk to you about is to look at the historical trend for rate changes. This is a table published by Vertex. Obviously, for folks that have been in, you know, their lifers have been in the sales tax space for a little bit, you'll know that, you know, Vertex is a tax engine tool that's companies use to maintain tax rates, just because of the number of tax rates that are out there. We're well beyond, I think we're up to what, 13 or 14 now, Tom?
1,000 different jurisdictions. Yep.
Yeah. So trying to maintain this manually is just not a thing anymore. And then you can see is that consistently over the last 10 years, Vertex has published that the average number of changes surpasses 500 a year, which is pretty significant. It's a lot to keep. Yeah. So, you know, and then the question is, you know, we'll talk a little bit about it as we go through the presentation and the webinar. But a lot of clients are starting to look to solutions to maintain that, because the states are continuing to expand the base. So, so in summary, for some of the recent trends, just to call out the numbers, a little over $1 billion in state local revenues in fiscal year 23. It's almost half now of local tax revenue, state and local tax revenue. So, obviously folks should prioritize sales tax. What hasn't necessarily changed is there's still 45 states that impose a sales tax, but the states that don't have a sales tax, just keep an eye out for other types of taxes like Delaware. It might not have a sales tax, but they have a gross receipts tax they impose for doing business in their state. So that's just something to keep in mind, different way for them to generate revenue. And again, last year alone, there was close to 600 rate changes. So those are certainly things you want to stay on top of. So let's, now that we've talked a little bit about the trends, Tom, I'll jump in, talk about Florida, and then move on to some other states to talk about some highlights of more recent changes that certainly could impact your business. So let's start with Florida. So with Florida, for those folks that have done business in that state, they're familiar with the commercial rent tax. The good news is that it's being eliminated effective October 1st, which is coming up here pretty soon. So that's great to hear. That certainly can help businesses in Florida. So if you are filing, just remember that's something you can work towards closing out.
Yeah, I think it's important too. If you have an existing lease, or you're a lessee or you're a lessor, I mean, you need to talk to that other party about that lease agreement, because it probably does include sales tax going out past this, especially if you entered into the lease a number of years ago. And, I think you need to make those adjustments, especially if you're auto paying or you have like a certain amount being deducted from your account for that lease. It probably includes sales tax. The other interesting thing too is Florida's not very clear if that's your only business there. What do you do with your return at that point? Can you just close your account out? They've made the indication that they'll automatically close or adjust for the accounts, but I don't know how they're going to do that. Like, I don't know how they're going to know your only activity is commercial leasing. So we have a number of clients for sure that we assist with Florida commercial lease filing. So we're going to have to really get on that after this month. This will be the last month we'll be really filing those returns and paying the tax.
I'd be surprised Florida would proactively do that for you.
Yeah.
Because, I mean, think about the number of deceased people that got COVID checks.
Mm-hmm.
The feds had a hard time figuring out the changes. So I imagine Florida's going to struggle too.
Yeah, I mean, I don't think you're going to necessarily file a zero return, right? Or that wouldn't make sense to me either if that's your only business activity. But I mean, again, too, you have to do something with that account because you can't not file.
Correct. Yeah.
That's, we see clients all the time who do that. Oh, I didn't have any sales. I had no activity. I don't need to file this month. And all of a sudden you're getting notices saying, where's your return? And, they're going to start levying and, all sorts of interest and penalties will be, assessed. So you got to really get on that.
And that's a great point, because we had a client recently in New York, didn't file returns. The state actually took it as far as issuing a warrant.
Oh, yeah.
And it was over zero returns.
Mm-hmm.
So they ended up having like a $2,000 penalty.
Yeah. Been there, done that. I've, gone through that myself with some clients. Yep. All right. We'll move on to Illinois. Illinois was a very active state, especially the early part of 2025. A lot of new guidance came out. The first thing we want to talk about is the update to their destination-based sourcing rules. So basically, on January 1st, 2025, if you were an Illinois retailer who had a place of business in the state, you had a brick and mortar location, and you sold tangible personal property from a location that was outside the state, so the inventory was coming from somewhere other than in Illinois, you now have to start filing your sales tax based on the destination of where that property is being shipped to, right? Prior to that, Illinois was kind of a mess with this because Illinois uses origin-based sourcing. So an origin-based sourcing is the tax is collected and due based on the origin or the point of the retailer selling it. So what happened was Illinois tried to level the playing field a couple different times to kind of account for this disparity between out-of-state retailers and then in-state retailers. So back when Illinois first enacted their economic nexus laws, if you were an out-of-state retailer who hit their threshold, which was $100,000 or 200 sales, you collected sales tax based on the state use tax rate of 6.25%. And that was it. If you were an in-state retailer, you collected origin-based at your location. So there was a disparity in the rates. So Illinois changed that and said effective 1/1/21, all out-of-state retailers had to use the destination-based sourcing. So now the out-of-state retailers were kind of up in arms, because if you were an in-state brick and mortar store, but let's say your inventory wasn't located in the state, the inventory was sourced from somewhere outside the state and then shipped to the customer, you only had to use the state use tax rate of 6.25%. So this new law kind of accounts for that and basically says, okay, I got a brick and mortar location in Illinois. If I sell it to a customer, he picks it up for me. I collect the retail occupancy tax rate at my location. And now if that inventory is coming from out of the state, I got to collect it based on the destination. If it sounds confusing, it is. And Illinois is not great with stuff like this, and they really make it very complex, as you see, excuse me, on an upcoming slide. Go ahead, Carolyn. So again, this really is just saying if you're an out-of-state retailer, which I think a lot of people probably are, you know, you have economic nexus. There's no change that you needed to do as of January 1st, 2025. It was an administrative where you went from a change in your registration status from use tax to retail occupancy tax, which is what Illinois calls their sales tax. They did it automatically. So really, it was only the in-state retailers that you'll see on the next slide. Talking about complex, this is Illinois for you, where it's talking about making sales to Illinois customers and whether you're using a marketplace or you're outside of a marketplace. And really, where you see on the right, where it says, do you have physical presence in Illinois? Yes, that takes you to the changes that were really effective 1/1/25.
All right, I'm gonna stop you for a quick second. Everybody, you know, just so you know, this is in the handouts and it will be emailed to you. Don't lose, you know, sleep over not being able to see this or read this depending on what screen you're on. We will send this to you. So.
And the link to it is on the previous slide too. Right. It's highlighted where it says making sales to Illinois customers flow chart. So yeah, I included that for you because I know it's a little hard to read, but wanted to show this because sales tax is complex. If you deal with states like Illinois, California, Texas, it gets really, really complex. So just wanted to kind of apprise everyone of that change or that development there. So Illinois, we had another change as well on the next slide. And Gerard's going to talk about this too with Maine, they changed the way they applied their sales and use tax to the rentals of tangible personal property. So prior to January 1st of 2025, a lessor had to pay sales tax on any tangible personal property they were renting, and then the stream of lease payments weren't subject to sales tax. Excuse me. As of 1/1/25, Illinois said, no, we're not going to do that anymore. If you're a lessor, you can use this CRT 61, the certificate for resale, to claim an exemption when you purchase that property that you're going to be leasing to individual customers. So you're not going to pay sales tax up front, but now you're going to charge sales tax on that lease stream as you're leasing or you're renting that property. And you're going to be using the destination-based rate for that as well. This isn't applicable to motor vehicle leases, and it's not applicable to the license of computer software either. It's really just if you're, you know, in the business of leasing fork trucks or, you know, construction equipment, anything like that is where this would be applicable. And then some interesting news out of Illinois too. they also decided to enact an amnesty program. And for those of you not familiar with amnesty, because they are kind of few and far between these days, an amnesty program is an opportunity for an unregistered taxpayer or even a taxpayer that has an assessment outstanding from the state to kind of come forward, pay the eligible tax liabilities. And in Illinois' case, they're offering complete forgiveness of interest and penalties this time around for any taxes that are paid in full during the amnesty period. And the amnesty period is October 1st, which is right around the corner, through November 17th, 2025. Key thing is you have to pay the tax during that period in order to get the waiver of interest and penalty. So that's very important. And for sales tax, which we're talking about, the eligible tax periods are really July 1st, 2018 through June 30th of 2024. So if you had an outstanding liability, maybe you were over that $100,000 nexus threshold, this might be a good time to come forward, pay the tax due, which, that's always tough, but at least in this case, you're not going to be subject to any interest or penalties. The one thing you do need to note with this is that the eligible tax liability period ends June 30th, 2024. So what happens from July 1st to now? Illinois doesn't really address that. So you have to kind of think that maybe that year is going to be subject to interest and penalties. So if that doesn't really appeal to you, there's always the course of action of taking voluntary disclosure. Illinois has a great voluntary disclosure program. It's got a 4-year look back period, but you will pay interest on those liabilities. So it is something to consider and evaluate whether amnesty or VDA is the best course of action for you. And in any event, if it's a sales tax liability, you will file returns. You're not going to just be able to submit a spreadsheet summarizing your liability. You will have to prepare and file the sales tax returns for each period, whether it's quarterly, monthly, whatever. I did provide the guidance, it's Illinois FY 2026-01. That does provide further guidance on this. And, we've been reading up on it too, to advise our clients as well if this is something they want to pursue. So now that I'm done with Illinois, you can see there was a lot. I'm going to hand it over to Gerad, who's going to fly through a few other states here.
Yeah, thanks, Tom. So other states to highlight, Louisiana is the first one. So we call it tax overhaul. Really, it's the expansion of their tax base and increasing their rates. Mm-hmm. Things to look out for is this was a 1/1/25 change. Mm-hmm. So you got a state level increase from 4.45 to 5%. There was a significant broadening of the base. They added technology services like SaaS, the digital products, and now information services are subject to tax. So those are things that weren't historically taxed in Louisiana, but they are now, and that seems to be a trend.
We'll see that, coming up.
And we'll talk about Maryland in a minute. Maryland's following suit. And I'm sure there's other states that are considering the taxing of services that historically haven't. So with every, bad, there's bad, things to think about as they've released or eliminated some exemptions. So the guidance that was published is very good. If you guys have any questions or follow up after the presentation, we can connect you on that guidance. It's good. It really goes into some great examples that you can help understand whether you may have lost an exemption or if one of your products is now subject to tax. Delivery charges are now included in the sales price, like many states. It's about a 50-50 split across the country.
Yeah, I would say about that.
But they've now joined the dark side as it comes to that. And then with all of that, they did you a favor and they said, okay, file and collect my tax for me. But oh, by the way, now we're going to give you a little bit less of a discount. So you can see they reduced their vendor collection compensation from $1,500 down to $750. So that's a quick update on Louisiana.
And like Gerad, Louisiana has never been easy. with
No.
the parishes.
Especially with the home rule.
Yeah,
issues
home
in
rule
Louisiana.
parishes that collect and administer their own sales tax. I guess at least the one good thing about Louisiana, if you are a pure remote retailer and you have no physical presence, you can file that return that has the one rate.
Yes.
On it.
Simpler.
Yeah, the simplified rate. Alabama does it too. That is the one good thing, but if you do have physical presence and you are subject to filing parish returns, which that's a whole animal that you don't want to really get into if you don't have to.
Absolutely. That's a great point, Tom. So let's shift gears and talk a little bit about Maine. Similar to Illinois, they used to require that lessors would pay sales tax on the purchase of equipment and then not charge any sales tax on a lease stream. With a recent change, this is effective January 1 as well. Lessors now can issue a resale certificate, purchase the equipment tax-free, and then turn around and charge sales tax on the lease stream. If you think about it from a cash flow perspective, that's a win for the lessee. So when you think about like going to make these changes, like how does it benefit you? That's one of those areas where if you can pay sales tax over the lease payments versus having to pay it up front, that's a win for the lessees. So just something to keep in mind if you have operations in Maine and you're leasing equipment, whether you're the lessor or the leasee, it's certainly a change you have to consider. All right, so speaking of digital taxes, Maryland is one of the latest to go live with a new digital tax. This was a change that was effective July 1st. It has a new rate of 3%. For those of you that have done business in Maryland, you realize that they have a statewide rate of 6%. So, again, when we talk about rate changes and new taxes and different rate structures, this is a new one. Didn't exist before. And it applies specifically to a number of different digital services, including things like data processing, software as a service. You've got website development or some examples. And then you'll see is we listed which services are considered under this new legislation. It's in the NAICS sectors 518, 519, 5415, and then 5132. So you may want to check to see if you fall in those sectors, because it certainly could impact your business. And like we've been talking about new taxes, new states expanding their base. Maryland historically has not taxed services. They did try here a while back to impose a tax on advertising services. And then this is their latest try at trying to rope in some services that they haven't taxed in the past. So let's dive in a little bit deeper here and talk a little bit about software as a service. Because obviously most businesses purchase software that's used in the enterprise.
Yeah.
They do, as part of this new legislation, they did provide a carve out. Historically, software that was delivered electronically and used in an enterprise was not subject to tax. But with this new legislation, they've imposed a 3% tax on the same type of software use. So that's just something you got to keep in mind. So it's no longer tax exempt.
But how do you know your customers too sometimes?
True.
I mean, I could see getting into a position where you're charging the 6% because maybe your customer's a name, a person's a name, but it's really a business. I mean, how do you know that? That's,
What happens if it's sole prop, right?
yeah, I mean, I could see a lot of issues being.
So this is
generated with that.
it's very similar to New Jersey.
Mm-hmm.
Where New Jersey provides an exemption if it's digital and it's used in a business. North Carolina is pretty similar. And it seems like a lot of the streamlined states have something like this, but it's certainly something to keep in mind. And then the thing to look out for here is that, SaaS it fits a couple definitions in Maryland. And because of that, it is subject to the 6% unless it's used in an enterprise. So you've got to qualify that first before you can take advantage of the reduced rate. So it's something to look out for in Maryland. And then because of the new digital tax, Maryland created an NPU certificate, like other states like Ohio, Washington. there's always things to look out for and to be careful with these MPU certificates. It's pretty common to allocate these days software, based on users or license in a
Yep.
particular state compared to the total, globally. So that's pretty common. So Maryland's not doing anything new here. But what Maryland's doing new here is how they qualify you. So you got to look out for this. You just can't use a resale certificate and think it works the same way as an MPU certificate. And I listed out on the slide because I thought it was really important for everyone to be careful with, is that you have to be registered for sales tax. See, if you're not, you can't issue the certificate, which is
Makes sense.
clever on their part. And then the second thing is that in order to issue the certificate, you have to get pre-approval. So they want to know everything that's going on, obviously. And then the last thing, obviously, you got to get that prior authorization because you can't request it. And then there's a number of things that come with that, right? You might be on the hook, for taxes if you weren't allowed to issue the certificate, those types of things. So you got to keep that in mind. And certainly that's the catch, right? They want to know what's going on, so they can keep track of it.
Yep.
And then the last thing here to drive home, when you start using these MPU certificates, it might give you an advantage in one state, right, Tom?
Oh, yeah.
But then when you're starting to divvy up your software by states, some states might not tax it, like New Jersey, North Carolina. But then other states like Arizona, Texas, Louisiana, Washington,
they have higher rates
they
too.
tax it. And then, so you got to think about self-assessing the use tax.
Yeah.
I mean, that's still due. The certificate doesn't get you off the hook in these other states that you may owe some use tax. So that's things just to keep in mind.
That's a great point.
So that's a little bit about Maryland. Let's talk briefly on New York, for the folks that have enjoyed in the past renting through Airbnb and Vrbo. Unfortunately, New York has decided that this is an opportunity to raise some revenue. So what they recently did, effective March 1st, this passed some new legislation that now expands the definition of what a short-term rental is, and websites in resellers like Airbnb and VRBO are now required to collect sales tax. Similar to if you go to a hotel. So it kind of levels the playing field, but then you don't have that advantage anymore. If you want to do an Airbnb instead of a hotel, where you might have saved yourself
A couple bucks on that, yeah.
So that's the good and the bad with that, but that's a more recent change in New York that certainly you may have saw recently if you've rented from either one of those websites.
The occupancy tax too, the
That's-
countywide occupancy taxes. I think,
3%.
yeah, they've been collecting that though. Airbnb was good about that in New York. They were collecting the local occupancy taxes. It was just a sales tax issue that they didn't want to deal with.
Yeah, not because the state recognized that the definition
Oh,
excluded
yeah.
them. Yeah.
Yeah, they needed to make that
Yep.
change. Yep.
Like I could only imagine, and especially with more people using these short-term rentals.
Oh, yeah, for sure.
Yeah,
Yep.
losing money. All right, Texas. Let's talk about Texas for a couple minutes. So they've recently made some changes around their data processing rules. Before we jump in, just remember this: if you're selling what statutorily meets the definition of a data processing service, in New York State, a good example, or excuse me, Texas is a good example is software as a service. There's special rules around the taxability of that transaction and then the tax base. So the good thing about Texas is they provide a 20% exemption. So the other way to look at this is that 80% of the sales price is subject to tax. So keep that in mind before we kind of go on. But one thing you'll see, and I want to point out on the slide, is they've now included in given some examples of different things that might be considered data processing. And there's like things like search engine optimization, social media marketing, all these things where like you think about like BJ's sends you coupons that are very personalized. They're using software to do that, right? And those are the types of things that Texas wants to tax.
Oh, yeah.
So they're definitely expanding that. So keep that in mind. And then probably one of the more critical changes is it's now sourced on where the services are used. Now that can be interpreted probably in 10 different ways, right? So that's something we gotta something to keep in mind. Let's talk about Virginia real quick. In the past, you used to have to prove that software was delivered electronically. Virginia didn't recognize that the rest of the world was delivering software electronically. There's a court case, in Virginia that talks about the that you had to, if there was you were reserving the right to physical delivery, you're required to pay sales tax on the sale, which is silly, right?
Yeah, who buys software?
Nobody does that anymore.
No.
Are we
So-
mailing discs and
Yeah.
USBs?
I'm getting my AOL.com disc,
Yeah.
getting a CD in the mail, yeah.
So good news is Virginia's joined the rest of the world. They treat electronic software is all sales is electronically delivered. Obviously, you just got to be careful and to remember that if it's being transferred on a computer, you can't carve it out because it's being transferred with tangible personal property.
Mm-hmm.
So that is a carve out or an exclusion or exception so that remains taxable. And then if you have like a bundled hardware agreement that has both hardware and software maintenance, the bundle rules are going to kick in, and you gotta keep that in mind. So things that certainly keep in mind in Virginia, but that's a great win for taxpayers in Virginia. So Tom, let's talk a little bit. I think we're on to Washington now.
Oh my gosh, Washington. I mean,
Oh, boy.
you talked about Louisiana and Maryland with base
These
expansion.
guys sound busy.
Washington's been very busy. As of October 1st, there's a whole slew of new services that are subject to the retail sales tax. Washington passed what they call the Engrossed Senate Substitute Bill 5814 back in August. So ESSB 5814 effectively added a whole lot of new services subject to sales tax. And these services all have most of them have a digital, electronic, commerce-y type, tinge to them. So that's something to be very, aware of. And you can see here where advertising services, live presentations, IT, custom website development, and then instant investigation, security and armored car services, temporary staffing, custom software. It's a lot to go on, and Washington's been busy pumping out a lot of new guidance on it. There's a few that I wanted to focus on because I thought they were very important for customers who are selling into Washington or have locations in Washington state as well. So we'll get into a few of these here on the next slide. Advertising services. According to Washington, advertising services means all digital and non-digital services. That's important, digital and non-digital, related to the creation, preparation, production, or dissemination of advertisements. And you can see here, Washington is serious. They are looking at both your traditional type of advertising services where you have layouts, graphic design, mechanical props, production supervision, acquisition of advertising space, and rendering advice. I mean, all of that is now subject to sales tax if you're a traditional type advertising agency, but also businesses do a lot of online and digital advertising. So whether it's search engine marketing or optimization, web campaign planning, acquisition of advertising space, digital media, online, and then evaluating that website traffic, all of that's now subject to sales tax. All that type of SEO and search engine optimization. If you're a business that does that or you buy that, that's going to be subject to sales tax now starting October 1st. And then furthermore, on the next slide, we're going to talk about IT services. This was a pretty big one to me because they're kind of encompassing any type of IT services, from assisting with network operations and support, help desk, in-person training related to hardware, software, network support, data entry, data processing. A lot of this stuff, a lot of states do not tax this, but this is significant base expansion with Washington, where they're picking up all of these new activities, including, like you can see some of the examples on here, onboarding and offboarding services, consulting and project management, network security management and implementation. There's a lot, and this is a lot of businesses do this, or they outsource these types of services to third parties. So you need to be very careful that you're paying sales tax on this or accruing the use tax if necessary, starting in October. They also went further into website development services here on the next slide. Again, the service traditionally kind of been non-taxable by most states. Washington's now considering any type of website development subject to sales tax. And that means the design, development, support of a website provided by a website developer to a customer. So these design services, development services, whether front end, back end, and then they also kind of got the supporting the functionality or operation of a website as well. So that could be any type of optimization services like we talked about, any consulting and training supporting the website, all now subject to tax. They did not include web hosting or domain name registration services. But whether you're developing a new website or you have an existing website that's being maintained by a third party, these services are now subject to sales tax in the state of Washington. And then finally, the last one I wanted to focus on with Washington, and this is really kind of cutting at it with sales of custom software and the customization of pre-written software, regardless of how it's delivered. So regardless if it's whether digitally downloaded from a third party, whether it's SaaS, whether it's sold on a per use, per user, per license subscription basis, any type of custom software is now got to be subject to sales tax. And honestly, 25, 30 years ago, I think you saw a lot more custom software. I don't think you see as much custom built from scratch type software anymore. I think everything is some degree of pre-written, and then it's customized, right, for the individual user or individual business. But that's all now subject to tax. And the one thing that comes to my mind, jumps to me, are ERP systems, right? You buy your SAP, you buy your Oracle, you buy even the lower level ones, you buy that license, and that's pre-written software. That's fine. It's always been subject to tax. But the customization of that for your business, that is, 10, 20 times the cost of the software. And now that's going to be subject to tax in Washington. So Washington really, really went full bore into this base expansion. And that's something we're probably going to be looking at now in other states. Here's Louisiana, here's Maryland, here's Washington, all in 2025 with significant broadening of the sales tax base. Who's coming up next, right? So, and then finally, before we touch on some economic nexus updates, just some miscellaneous things that I noted along the way. And you can kind of see here, they're generally in the same type of category, whether it's eliminating statewide sales tax on food and food ingredients, grocery type items. We see that happening in Kansas. That happened at the start of the year. Illinois is going to eliminate their 1% state tax on groceries effective January 1st of 26. But in both cases, with Kansas, with Illinois, saw this in the past with Virginia as well, they still allow the localities to implement their own sales tax on it. So you have to be very careful, especially if you're selling these type of items maybe online or remote, that if there are local taxes that apply, you're still picking those up. And then the other trend that's been happening over the last few years we're seeing a lot of states, exempt the sale of, diapers, menstrual products, stuff like that, feminine hygiene products, the so-called pink tax that it was called. A lot of states are eliminating that. You can see Nevada, Alabama here. Alabama had a very broad exemption for baby products that they're putting in place, including like formula, bottles, baby wipes, maternity clothing. That's all effective at 9/1/25, but it does not apply to the local taxes in Alabama unless it's approved by the local governing body. And then finally, the last update I want to kind of talk on was Washington, D.C. On the next slide, Washington was supposed to increase their sales tax rate 10/1/25. They were going to go from 6 to 6.5. I think there's two more.
Oh, sorry.
Yeah, no. Okay. So no, never mind, Carolyn. I thought there was something else with that. But no, they're not going to make that change. They're going to make that interim 0.5% change. They're just going to go from 6 to 7% now on 10/1/26. So if you were planning on making that change, Washington decided not to do it this year. They're just going to do a full 1% next year. So Gerad, what's going on in the wonderful world of economic nexus?
All right, before we jump there, Jamie had a question regarding New York State. I don't know if you want to take that one,
Yes.
Jared, before we move on to Nexus, and I'm assuming maybe we'll hit Scott's question in the Nexus section, but.
Yep. So this is the recycling one, right?
Yep.
Yeah. So in New York State, they impose sales tax on the service to real property, which includes waste removal services. There are some carve outs if it's in connection with a capital improvement. So we'd have to consider all the facts before we make that decision. But certainly an opportunity if you have a construction business and you're using a hauler to remove your waste from the location, the job might qualify as a capital improvement. And then the second thing is, remember, they tax waste removal. And there's times where waste has economic value, and if it does, then it might qualify for an exemption. And for those of the folks on the call that are familiar with New York and past cases, it's the Seneca Foods case is the precedence that's there and available to say that, if your fact pattern is similar, you might be able to qualify for like almost effectively an exclusion, or it doesn't meet the definition of waste. So certainly if you have, those fact patterns, reach out to us and we can talk after the call. We can kind of see if there's an opportunity for you, depending on what your facts are.
Great, hopefully that answers that for you, Jamie. If not, throw another note in there if you have an additional question or want to talk to Gerad specifically on it. So then I think otherwise we'll move on to economic nexus.
Right, thanks, Carolyn. So a couple things to point out on economic nexus. And again, to Tom's point about when you see states like Washington, Louisiana, starting to expand the base, is that all the states talk to each other. And then once they see a state, like increase the revenue because they expanded their base, the others will, come along. Marketplace, providers, economic nexus is a great example of that. So, keep all that stuff in mind. So what are we seeing with economic nexus is they haven't simplified anything really, in a sense of it's new. And that's why we asked the question in the beginning. We're finding now that monthly and quarterly reviews are actually better than doing it annually, because we have one client, they just had an order the other day for like $300,000. And unfortunately, that tipped the scales. So now they got to register. But if they wait 6 months, now they're on the hook potentially for 25 to 30,000 in liability.
And
so it's got to catch more time.
Yeah, and they don't make it easy. The states, when it comes, some states they all have different guidelines when you need to register.
Yeah.
Right.
Like periods are different.
Yeah, like let's say you hit it in Michigan or Florida during the year, you don't have to register in those states till the first day of the next year.
Yeah.
Pennsylvania's even goofier because it's like the by the end of the first quarter of the following year. But then like California and some other states say the next transaction. Well, how you got to know if the next transaction, if you're not like monitoring your sales on a pretty regular basis? Is like you said, Gerad, you could have a gap, a 3-month gap where you should have been registered. If you had a big sales period in there, you could be on the hook for some exposure.
Absolutely.
Oh yeah,
It's huge.
brutal.
And we're finding that more and more. So we're looking at like developing tools to be able to monitor that, not just a spreadsheet, you know, because it's so hard to keep track of all the, and unfortunately it wasn't 100,000 in sales.
Yeah.
It's gross, it's retail, it's taxable,
Yeah,
it's PUC,
yeah.
and the list goes on. The good news in sight is that several states have eliminated the or 200 transactions. That's the newest trend. We're envisioning that a lot of states are realizing, okay, well, you got to have some economic, you know, tie to the state versus 200 transactions, because I could have $210 transactions. You're going to make me collect sales tax
For $2,000 that's sales. I
that's
mean, it's
ridiculous.
nuts. Yeah.
Yeah. So the good thing is they're starting to realize that there has to be, you have to have a volume of sales. I still think 100 is too low, but unfortunately the states need their money. So that's something we're going to have to live with for the foreseeable future. So just, you know, keep that in mind. We've included a couple slides of the states that recently dropped off the 200, or we're expecting more. And then the last slide on economic nexus shows a state by state. There's always exceptions with everything and states to look out for. Connecticut is a great example of, they have an and instead of an or. So you got to look out for those things when whether you're using a tool, you know, Google, make sure you pay attention. Sometimes the little words are the ones that cause the most pain if they're interpreted incorrectly. So, because if you go or in Connecticut, you're going to miss when you need to register.
Yeah.
So it's really important. So Tom, let's jump in. We'll the remaining time we'll talk a little bit about the 2026 outlook and what we expect.
Before we move off of that, while we're still in the nexus category, I'm going to jump over to Scott's question. He had quite a lengty question for you, Tom.
Yeah, I'll read it for everybody. It says, determining if economic nexus applies and complying with its requirements when it does have obviously become administrative burdens.
Yes.
Regardless of the opinion of a majority of the Supreme Court. It was a close majority, but yeah. I've recently read about adopting the strategy of shipping all tangible personal property as FOB origin. So FOB shipping point with the corresponding transfer of title happening at the seller's dock. This would effectively limit the sales tax exposure to only the states where the seller has physical nexus, and thereby eliminate the burdens of economic nexus. Realize the strategy might not be feasible as customers may not accept the practice, but is the strategy legal? It's a great question. And just for some people, we're talking about FOB origin or FOB shipping point, which is basically a terminology, or it's FOB destination, whereby title and the transfer of title really doesn't, if it's FOB destination, title doesn't transfer until it reaches its destination. If it's FOB origin or dock, then title transfers on the loading dock, and typically in that case, the buyer, the purchaser, is responsible for the shipping. This way they bear the burden of the shipping cost, and they bear the burden in case something happens to that shipment, it's on them. So, you know, we've talked about that a lot of times too, with some clients have, you know, brought that up. You know, the one big problem with that is then, let's say it's New York and it's FOB origin. Well, you have to charge New York sales tax then at that point, at the origin point. And if you're dealing with a customer where you're shipping something to Tennessee who doesn't have a New York resale certificate or doesn't have a New York manufacturing exemption or anything like that, they're not registered in New York, then you're charging them sales tax, and then they have to go about getting that refund, proving that they didn't use that item in New York, and then going about and filing an AU11 and getting a refund claim, and who knows what other doors or, you know, Pandora's box opens up for them. Maybe they are subject to tax in New York.
What about like North Carolina and South Carolina with temporary storage too, right?
Yeah.
You know, like, and if you're charging, because that's a privilege, more of a privilege versus a sales tax.
Mhm.
You know, those are things to consider too, because you may not be able to get a refund.
No,
Yeah.
definitely not.
Yeah.
Yeah, New York's gonna give you a hard time on it.
Yeah.
Too. So, I mean, it's a strategy that, you know, it's legal if that's your terms, your shipping terms stuff will be origin. You know, that's fine. You could do that, but then you got to be aware that you need to charge sales tax. Your customers may not have the proper forms or documentation to cover an exemption. And then, you know, they're going to have to go about and accrue use tax in their state as well, wherever they're using it, if it's subject to tax. So it's creating a big burden on the customer. And I think a lot of customers you'll find don't want to deal with that. I mean, they'd rather just be charged the sales tax, and that's the end of the day for them. To have to jump through those hoops in many cases may not be something they want to do, and you know, they may just try to find something somewhere else. So that, you know, legal, nothing illegal about it. You can do it. It's just, I think it creates a whole other set of burdens administratively, I think, for both the seller and the purchaser.
Great question, and really
Mhm.
something to think about, and the impacts on others. All right, we got about 5 minutes or less, so let's do the 2026 outlook and see if there's any other questions coming in.
Yeah, I mean, I'll take the first three here. I think you've clearly seen, based on what we've talked about in the last hour, that sales tax base expansion is here, and I would expect it to continue into the new year. We talked about Louisiana, we talked about Maryland and Washington with some significant changes to their tax law affecting services, software, digital goods. So it kind of 1 and 2 kind of go hand in hand in my estimation. So I think that's where you're going to see a lot of states, if they are not already, you know, enacting new tax laws regarding, you know, SaaS, regarding information services. You know, New York, we're kind of familiar with it. These New York taxes, information services, they tax software as a service, they tax pretty much everything. So it's nothing new to us, but I think you're going to start seeing this in a lot of other states. And the one thing I did want to mention, I forgot when talking about Washington, not only, you know, you have to deal with the sales tax, but you have the business and occupation tax as well. You're going to have a retail B&O that you as the seller of those services is going to have to pay, you know, because Washington does not have an income tax. They have a gross receipts tax called the business and occupation tax that you can't pass through to the customer. You have to pay it in lieu of an income tax. So that is something you have to consider as well. Hopefully we see more simplification of the thresholds. Really probably just dropping the 200 transactions. You know, like Gerad referred to earlier, the states still have different rules regarding what sales are included, you know, gross, retail, taxable, when do you need to register, all stuff that is very complicated for a business is trying to sell in multiple states. Gerad, what about sales tax automation? That's right up your alley.
Yeah, I mean, we're seeing, because of the complexity of sales tax, we're seeing more and more people consider, you know, implementation of technology to solve these issues. Because to be frank, you can't run your business if you're manually maintaining rates. You're trying to figure out what's subject to tax. You know, if you're doing a Google search at the 9th hour saying, hey, I'm going to sell this new product, you know, those types of things. Whereas that technology, because more and more people are adopting it, right? It used to be custom. Now it's much more of a canned solution that, you know, the average person can implement, or, you know, like they've built the UIs where it's easier to stand it up. So, you know, we're helping clients, you know, do more and more of that work to make it easier for them. And especially in, you know, businesses that are reselling products and they're blowing up overnight with sales to all 50 states. And it's really it ends up being one of the, probably almost the only solutions, right, to stay ahead of it. So,
and the thing about that too, Gerad, I know, like, you know, we're familiar, we do a lot with Vertex, we do a lot with Avalara. two of the bigger mainstays that have been out there in this space, sales tax automation. But really this year, there's been a proliferation of new services to do this, new online companies that I just had a client contact me about one or two of them. I'm like, well, I don't know what that is. You got to be very careful. I mean, you have to look at the pricing and look at what's going on, and their pricing might be cheaper, but what are you getting too? I mean, for the Vertexes of the world, Avalara, Sabrix, I mean, they've been around, they're well established, and we know what they can do. What about increased tax enforcement, Gerad?
Well, I mean,
As a former auditor.
yeah,
here.
former auditor, came from the dark side. We got a couple of clients that are seeing this, and now that COVID has passed
Mhm.
and the government's back to work, they're picking up the pace on audits. I've seen audits get scheduled without an auditor. So that sounds crazy, right? Like, how can you schedule an audit to protect a period? So it's something to think about, right? That's the type of enforcement that's going on right now. Most of the time they're doing desk audits now and maybe not coming on
Yeah.
site thanks to technology.
Mhm.
So that's probably, helpful and not less disruptive for your business. But we're also seeing that they're auditing businesses that I wouldn't have, been part of when I was at the state. So they're working their way down in the different areas. So that's something to keep in mind. So just because you haven't been audited yet doesn't mean you will be in the future. So, but we're definitely seeing states looking for money. I think at some point with inflation, people are spending less. The state's going to try to raise revenue. But the one thing is always an interesting fact, is that audit is actually not a huge percentage of the state revenues. It's compliances, because most people want to do it right. But that's something to keep in mind, is that they're certainly picking up the pace with audits. And like I said, expect them if you haven't yet. They're probably on the horizon, unfortunately. So.
Yeah, and I think we talked about the tax rate changes. You saw that slide. I'm sure next year at some point we'll have a new one from Vertex that has 500-600 more changes on it, new rates and changes, and then retail delivery fees. We have them in Colorado, we have them in Minnesota. I think other states are trying to enact something similar, kind of a surcharge to really help with infrastructure costs and whatnot. But you got to watch things like that, those retail delivery fees, e-waste, carbon. What's the waste fee that we were talking about for that one client, right?
Mm-hmm.
So there's a lot of those out there that you might see more of as well.
And the thing to keep in mind, these might be transactional based, not product based.
Mm-hmm.
Is how they're applied. So you got to keep that in mind. And then again, if you have solutions, technology that's built in to apply it for you.
Mm-hmm.
So certainly something to keep in mind, but you don't want to be on the hook if you either charge too much or
Exactly, for sure.
So.
All right, and I think we have a webinar coming up in October, November with Vertex.
November we do, It's going to be focused on manufacturers, but certainly there's something everyone will be able to take from it.
Okay, so keep an eye on your email boxes for more invites for that. That's definitely something you'll want to take a look at. And as soon as we hear on these 2026 things that we're telling you to look out for, when they start happening, I'm sure you'll be hearing from us again early in the year. Here's the contact information before you sign off, just some other webinars that are coming up in October. It's going to be a busy month. Navigating M&A success, market trends, and deal structuring considerations. That is on the 7th. On the 14th, we're going to have cybersecurity best practices. And then on the 23rd of October is cost segregation. So if you're doing new construction, expansion of existing facilities, you definitely want to take a look at that one. Otherwise, have a great day. I will email you this afternoon. Please complete the survey that you receive when you log off, and reach out if we can be helpful to you. Have a great day. Thank you, everybody.
Thanks, everybody.
Thanks, everybody.